Today, investors keep buying chip stocks. We hit the firms on Wall Street to learn their favorite stocks in the space. Plus, the Ford Bronco is back from the dead, and it already has a nemesis. And finally, blank check companies are having a moment. We take a look at all the action in SPACs. I'm MacKenzie Sigalos, and this is CNBC After Hours. Let's take a look at how Wall Street finished the day. Stocks closed higher across the board. An impressive 557-point rally for the Dow, and all 11 S&P sectors finished in the green as investors shrugged off rising coronavirus numbers and increasing geopolitical risk, including U.S.-China tensions in the South China Sea. The banks issued a warning that there may be more economic trouble coming too. JP Morgan, Citigroup, and Wells Fargo reported quarterly earnings this morning, and those three banks have collectively stockpiled more than $25 billion to prepare for their customers to default on loans as a result of the pandemic. JP Morgan's CEO said on the firm's conference call that we'll be feeling recessionary fallout from the COVID crisis down the road. One last point about the bank earnings that I want to highlight here is Wells Fargo. The bank reported a loss, but the bigger news is that it reduced its dividend, which is the portion of its profits that it returns to shareholders every quarter. Wall Street saw this coming, but the reduction was steeper than expected. Wells Fargo shares tumbled about 4.5%, making it the worst stock in the financial sector today. It's also the worst performer of 2020 so far. And there's another type of stock I want to talk about, the semiconductors, or computer chips. The ETF that tracks these companies finished higher today, fresh off hitting an all-time high yesterday. Now, chip stocks have been surging this year, especially after the market bottomed in March. So where is this trade headed, and which stocks does Wall Street like the most? CNBC's Josh Lipton talked to stock analysts and has those details.
Investors keep charging into chips. Check out the SMH. That's the ETF that tracks the chips. It has now surged more than 60% from its March lows. Big winners so far this year include names like Nvidia, Marvell, and AMD. Analysts at Bernstein Research pin this surge on two broad reasons. One, tactical, meaning expectations were just too low, but now, at least in the near term, business appears better than expected. For example, Analog Devices just agreed to buy Maxim Integrated for nearly $21 billion. It also raised its current quarter revenue guidance. Second, structural. In other words, the pandemic and resulting work-from-home trend has highlighted the importance of tech and chips in particular. Bernstein's top picks right now, Nvidia, NXP, and Broadcom. That stock is cheap, they argue, with a strong dividend, and it's well positioned given its deal with Apple. There are risks that chip investors need to think about too, though. Chip analysts at RBC point out too. In the months ahead, how will economic turbulence impact consumer demand for important end markets like smartphones and PCs? And increasing tension with China is another question mark. For chip companies, remember, China is an important end market and a key link in their supply chains. I did check in with Mitch Steves. He's the analyst at RBC that covers the chips. He's telling his clients right now, in terms of where to commit capital, he likes three names. He likes Nvidia and AMD. He thinks they're going to keep taking share from big rival Intel. And he likes another name, Applied Materials. Its equipment makes the chips that go into the data center.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves today.
On Delta, we are enforcing masks. You cannot board an airplane on Delta unless you have a mask on. And if you get on the plane and you decide that you're not going to wear the mask, we ask you kindly to put it back on. But if you insist upon not wearing the mask, we're going to insist on you not traveling on Delta in the future.
If it takes you 8 days to get tested and get a result back, that's not smart testing, that's wrong. So the central question is, why do we not have a national plan that someone is overseeing to make sure that there are all the adequate reagents, all the adequate test materials that we need to do the testing? And that's the challenge.
We believe that this is a way for us to enhance the jobs in our castles. So we've been around for almost 100 years, and over that time we've introduced new griddles, new register systems, Coca-Cola freestyle machines, and through all of that innovation, we've been able to help redeploy our team members to other areas of the castle and allow them to create more memorable moments with our customers. And that's what we see Flippy as, not a replacement for our team members, but an enhancement to their jobs that lets them do it better and creates a better experience for our customers.
We had set some very aggressive targets for ourselves on what we were planning to accomplish for the end of the year on Comcast, and we beat those targets within 60 days of launching there. So we're encouraged that the programming that we have really seems to be resonating, and when we launch tomorrow, we're only expanding that offering with original programming.
All right, I want to talk about blank checks, specifically blank check companies. At least that's how they're referred to on Wall Street. They're actually called Special Purpose Acquisition Companies, SPACs for shorthand. A SPAC is a company that exists for the sole purpose of acquiring another yet-to-be-determined company at some yet-to-be-determined time in the future. And there's been a ton of SPAC activity this year. According to Deal Logic, SPACs have already raised $12 billion in 2020. For context, they raised $13 billion in all of 2019. Two recent examples of SPAC acquisitions are Nikola and Fisker, two electric vehicle companies. Nikola went public last month via one of those SPAC acquisitions, and yesterday, a SPAC called Spartan Energy, which is backed by private equity behemoth Apollo, announced it would be acquiring Fisker. And here's the thing. Neither Nikola or Fisker have produced a car yet. So why are SPACs taking them public? And why does Wall Street call SPACs blank check companies? CNBC's Leslie Picker has the answers.
There's a reason that special purpose acquisition companies, or SPACs, are otherwise known as blank check companies. The reason is because as an investor, it's akin to basically writing a blank check to someone. You basically, as an investor, you hand over money to a shell corporation. That shell corporation has no operations. It's not really in the business of doing much of anything other than just being an entity by which there's a big pile of money that one day the managers of that shell company can go out and buy something. You as the investor don't know what that is when you're handing over money. You don't really know much in the way of the financials until that deal is announced. Then you do have the power as an investor to vote it down as a shareholder. For a company that's looking to go public, this is a lot easier route than going the traditional initial public offering route, where you have to have hundreds of pages of an IPO prospectus with all sorts of disclosures about your business. You have to go through weeks of marketing and meetings with investors to determine the exact price to set your shares at, and then watch those shares get traded. A SPAC, on the other hand, some people refer to it as a reverse merger, because what happens is this SPAC unit can acquire a private company, and then that private company becomes publicly traded once it's acquired, because it gives it an entrance into the SPAC, which is already publicly traded. In doing so, though, you don't need to have all of those disclosures that you would if you were a regular IPO. We're kind of in this period of SPAC 2.0. Historically, they were more associated with fraud. There were a bunch of Chinese companies, maybe 5 to 10 years ago, that went public through these reverse mergers that were then found to have some accounting issues. That's changed. You're seeing a lot of credible managers coming out, names like Bill Foley of Fidelity, Chamath Palihapitiya, who's a well-known venture capitalist. All of these guys are coming out with SPACs, and they have a storied reputation, storied history in the world of finance, so investors feel like they can trust these men to make purchasing decisions. Chamath Palihapitiya purchased Virgin Galactic, for example, by means of a SPAC, gave Virgin Galactic a mechanism to get public as a result, people have seen with various examples, whether it's Nikola, whether it's Virgin Galactic, you can become public through the SPAC mechanism, and you don't have to go through all of the nitty-gritty of the IPO process. You don't have to meet with investors, put your blood, sweat, and tears into a marketing event that then the stock starts trading and trades down and your employees get mad. This is, for a lot of people, a much less friction in the process, and so they see it as an easier way to be public if they need to be public.
Okay, time for today's numbers round. We'll kick it off with 10,000. Yesterday, nearly 10,000 Robinhood accounts added Tesla shares every hour for a 4-hour span, according to robintrack.net. Now, this data provides a glimpse into the extreme volatility in Tesla stock yesterday, which at one point was up as much as 16%, before ultimately closing in negative territory, down 3%. Of course, it's not clear that Robinhood traders were the main driver of the volatility, nor is it clear how much of an impact these specific traders have on the stock at all. But it is worth pointing out that investors, Robinhood or otherwise, have a lot of enthusiasm for Tesla. The shares seem to be unstoppable. They've surged more than 250% higher in 2020 alone. Next, $2.5 billion. In a major policy U-turn, the UK announced today that it will ban Chinese telecom giant Huawei from its 5G networks. The decision will cost the UK about £2 billion or $2.5 billion US dollars. So why will it cost so much? Well, it's a huge reversal for the UK, which in January allowed Huawei restricted access to its networks, meaning Huawei components would make up no more than 35% of the country's 5G infrastructure. But now, the UK is reducing that percentage down to 0, which will bring delays and added costs. The decision by the UK is exactly what the Trump administration wanted. The US imposed new sanctions on Huawei in May, causing the UK team to set up an emergency review of its own 5G plans. And finally, 30,000. Ford is coming for Jeep with the return of its iconic Bronco, and the base model starts below $30,000. The boxy SUV developed a cult following after it was discontinued in 1996. And almost 25 years later, Ford has taken the Bronco out of retirement with 2- and 4-door models with the specific purpose of taking on the Jeep Wrangler. According to Credit Suisse, if Bronco sales hit 125,000 units, the model would contribute nearly $1 billion to Ford's North American operations. That's it for After Hours, but before we go, here's one more thing to keep an eye on. Tomorrow, Peacock becomes the latest streamer to launch. NBC's streaming service gets its wide release after about 3 months of exclusive access to Comcast customers. We should note that Peacock is part of our parent company, NBC Universal. Get the latest on the streaming wars by going to CNBC.com and downloading the CNBC app. We'll be right here in our home office every Tuesday and Thursday with a new edition of After Hours, so be sure to catch us then.